Hello and welcome to this video on the FTSE 100 or UK100 trading strategy. So I'm going to share with you how I look at the markets on both a macro and then a micro scale, and in which order that I use to actually identify what direction I'm going to trade and then from where I'm going to actually enter in that direction. So I'm going to give you a quick overview and then I'm going to jump into why this is the way I do it. And then from there, I'm going to go a little bit deeper into what I'm actually looking for. I've got here a UK monthly chart, and each candle is 1 month of data. Now we can see here, there is a bias to the upside. There's more green candles than there are red. So that gives me an indication that ultimately the better trades are probably going to be the buy trades or the easier trades to find that will work. So I give myself a slight edge by looking for long side trades predominantly. The characteristic of this market is that the UK or a lot of indexes generally trend upwards, but then they have sharp spikes down that happen quite quickly and sharply before then retracing and continuing to the long side bias. We can see here by this chart, the monthly candles often react quite well to the Bollinger Bands. This Bollinger Band is set to a 2.6 on the close price, 2.6 deviations on a 20 period, and I usually make it yellow and I standardize that when I look at all my charts. We can also see that the market often pushes up quickly from the lows, at least over the last couple of years, and really hasn't been below this midline for very long at all, a maximum of 3 months in this case. So by having a look at the monthly chart, I get a feel for what the market has been doing over the last few years. I now go down to the weekly chart. We can see here we've came up to touch the upper Bollinger Band and we've came right down, and last week we saw a really positive shift and back up into the normalized recent pricing. We also saw a dip from this point down, and we once again see the market rejects quite quickly off these lower bands on the weekly chart. What I'm looking for is indication of anything that stands out. So for example, if I was trading on this candle here, I would perhaps be a little bit concerned about going long because we have reached that upper limit. If I was trading around these levels, I would be obviously looking for more buy conditions rather than trying to get tricked into going short, because the market is probably going to turn around, as we can see in hindsight. So getting a feel for the location of the current bar, it might give us some information on what we could do for the trading day. We can see here that for this week, we're trading in a fairly normal price range. So it doesn't necessarily tell us much other than we're trading in fairly normal conditions. So it could go up or down. As I go down through each time frame looking for clues, I research and try and identify key elements that might help me make a better trading decision. I can see here on this candle we've started turning red after a very positive couple of weeks. While it doesn't necessarily say we should go long or short, it has been very bullish of late, but there is a chance that we've hit these high prices where the market has previously turned back down from around this level, indicating that there may be plenty of sellers in the market should the market be looking to go short. The 4 hour is a good one. You can identify a bit of a trend, and you can see here it has been in a channel for quite some time on the 4 hour chart. And you can also see that there is some reactivity off the Bollinger Band upper and lower. However, this area here, well, if you did get long here, you would have made money. It still went well below that area. Working your way down is really important so that you can filter out situations like this if there's clues in the higher time frames. One indication that we may be going long over the next few candles on this chart is because we have previously found support off this midline on the Bollinger Band. Down to the 1 hour, we do see some reactivity on either side, but the market does often get below the midline and actually reach this lower Bollinger Band No clear indication from this chart, so no clues as to what I might do when I further analyse the markets later on from this chart. The M30 looks very similar to the 1 hour, and we're approaching the lower bands here. And on the 30 minute, we have been trending down for a little bit of time here. The 15 minute may be forming a bit of a bottom or a base based on the rejection, and it comes down further. So if we break below this level and all of this pricing structure here, it could be quite bearish. Whereas if we start going long, obviously that could be a bullish sign. I've got here on a 30-minute chart all of the previous levels that I've set out. These levels are the Camarillo pivot points, and I use them each day to try and determine what might happen, particularly at the opening bell for the London Open. We can see here that the market has been trending long, and often the market stays within these levels that are set out and often have some support and resistance off these levels. They form a very good guide as to entry points and targets. As you can see, a long bias would have suited this trading condition very well. So looking for longs when the market comes down and taps on certain levels, like this area here, off the close gap. Didn't quite reach the close gap, but it was a very flat day. Off the breakout short, we basically touched it to the point and had a very strong move up from that point. We touched the extreme gap here and a little bit further, but continued upwards. We reached the lower Bollinger Band as well on the 30 minute. Rejection off the pivot to go long. Had an R3 trade here, so basically the market hit that upper limit and retraced. However, due to the long bias, the best trades have been the buys off a certain level when the market starts to reject. The market has hit these levels, had a slight rejection, however it didn't continue on as of yet. So as you can see, the long bias would have been a really favourable condition during this period. Going back to understand a short bias period where the market drops sharply, we can see here that if we knew for some reason that the market is likely to go short based on our higher time frame analysis, we could look for entries bouncing off the high from these prices, perhaps off the low here because that's the extreme gap, so fading the gap. So when the market opens, we saw a really strong push up into that extreme gap, and then the market continued lower, and then on this day the market simply declined. So there was no real entry point as to which somebody might have got in from that 10 o'clock candle on this MetaTrader platform. So as you can see, identifying the short positions can be a bit trickier because it happens so quickly and there's not really too much rejection off levels. While it can be identified, it's a lot trickier to actually make it happen. So that was a 3-day period. And then even if you did have a long bias, let's say the market was outside the Bollinger Bands on the higher time frames, you're expecting it to go up. Let's say you bought it off this extreme lower level, the S3, within 1 or 2 days, you would be sitting in profit, and that market continued to rally from then on. So short, sharp bursts down, they're quite hard to identify and find a reasonable entry without thinking you have missed the mark already. As for the long bias, you can see this candle had quite a strong wick, and often the market will come down like this area here, tap the level, and then continue long in line with the macro expectation. So these levels I use every single day, and I'm using them to identify whether the market will either bounce off them or perhaps continue through them to the next level. And that helps me work out where my stops are, whether there's value in putting a stop on the other side of the next level, or if it's too far away, perhaps the trade's not worth taking, or keep the tight stop. These levels also help determine the value of the trade and any targets that you might have, along with how risky the trade might be. So if I was to get long from here, I would potentially consider that my stop needs to be below this area of all these levels. So that tells me that the stop would be perhaps 130 points, which is not of value considering the general range is far less than that. So these levels not only help to identify an entry when we reject off them, it provides an excellent opportunity to see where a stop might be safe and also identify how far the target may go. We've got the close gap here, which is the close from the previous day on the cash market. Often the close gap will be filled, and when the market opens outside on the 10 o'clock bar, outside of these two red lines, the high and the low of the previous day of the official cash trading area, it forms an extreme gap. So we can see here the high on the 7th of August from the previous day. The market is trading above that level in the pre-market. However, we can see at the 10 o'clock candle, it's already been filled. However, let's say the market was 10 o'clock at this level here, it could be a really strong indication that the market will aim for this extreme gap in market hours. However, it has been filled outside of the normal market hours and in the pre-market. The extreme gap forms a very high probability target in many cases. You can also see that it could have been faded to take a long position. However, this close gap is also likely to be filled, so getting long off the extreme gaps or short from the low, for example, can be a risky play because the market is often going to continue on and go to that close gap as well. Here's an excellent example of using the levels to target the extreme gap, using one of these levels to reject off, and keeping a stop loss outside of the expected range of the trade. So the opening candle was this one here. And we can see here the market came down, tapped the breakout short, and continued up for about 50 points. Tapped the extreme gap, which is the low in this case, and then faded. The market did come back and retest this area, which may be considered as filling the close gap also because it was quite close, and then it continued lower. For example, in this situation, I would have had my stops about 30 points away around here. So you've got the safety of the S2 hopefully being able to reject any further movement. But beyond that, we've got such a big gap, it's 90 points to the S3. So I wouldn't want to have my stops anywhere in this mid-range because the market could quite likely just keep coming down. So by placing stops outside of this confluence area here and this level, I'm accepting the fact that it may come down further, but if I get stopped out here, then it's likely the market will continue down this far anyway, and that stop loss would be too high a risk for the normal range of this particular market. So the value there is about 30 odd points compared to perhaps 50 to 60 points if you timed it quite well. So trading around the open time, there's an increase in volatility, and often the market is pushed into a direction that perhaps it might not normally go without that added volume into the market. All the orders are coming in, getting filled from the overnight trade, and it pushes the market in a particular direction, along with all the traders looking for the opportunities such as this. As you can see, once that normal trade has completed, you could be done and dusted with your trading day within, say, 30 minutes, and then it slows right down. Just want to dive into some of the elements of trading and why it's something that I do. So it's access to liquid cash fast. When you're trading with shares, for example, it's often T plus 2 or T plus 3. It takes multiple days to actually buy and sell the asset. There's no leverage involved unless you have, for example, a margin loan. So the borrowing capacity is less. With CFDs and trading markets like this, you can get in and out within half an hour, say, and the fees are respective to your position size, and they're very small in comparison to a traditional brokerage fee of buying, say, property or buying shares. It's very quick and easy to get in and out, and you know what fees you've been charged pretty much straight away. Most of the time, because of the nature of this style of trading, so we're getting in and out around the open time, most of the time your assets are held in cash in this investment. So effectively it's a cash investment that then transitions to an opportunistic investment for a very short period of time based on your knowledge and skill. You can easily maintain risk levels while accessing leverage, but you need to be smart about it. So creating that discipline is a really critical element, but you can control the risks. So you're taking snippets of market moves, reducing exposure to economic fluctuations. So you're not just sitting and holding a position all the time, stressing about it overnight or wondering what might happen. You're in and out, and then you know exactly the outcome, and then you're sitting in cash from that point on until the next opportunity arises. If the market is moving, there's opportunity for long or short. As mentioned earlier, so there's low cost and low fees compared to property and shares. And you can also benefit from the law of compounding returns on a daily or weekly basis. Because you're getting in and out, that's affecting your balance, and you can obviously compound based on the returns from that week. So rather than waiting for months or years, you're benefiting straight away. So this brings me to ask the question, why index markets specifically, or the UK100 in this case? So there's an open and close market time. So that means there's opportunities around the order processing, pre-market and market open. There's also end of day information, and where the market's closing, there's different opportunities again. Compared to foreign exchange, where there's no hard open and close time each day, it reduces the opportunity of knowing when these times occur and these market situations and opportunities. So that gives a slight edge to the index markets from that point of view. You can understand and dive into the underlying assets based on the stock market of a country. So if you know a country is performing well as a whole, economically, you can even dive further and understand the underlying companies in more detail, and in particular the bigger market cap ones that make up, say, 10 to 20% of the total market. If you understand those on a deeper level, you can have more information as to what the index might do. So there's just a deeper level of knowledge that you can work with here. The indices are designed to track the top companies by market capitalization, so country, index, number of constituents. So for example, the UK or the FTSE relates to the United Kingdom, and then the 100 is the companies that are tracked. So the number of constituents is 100. So 100 companies from the UK, or listed in the UK I should say, that creates a direction bias. This is because weak companies fall out and they are replaced with stronger companies to form the index. So let's say the 99th and 100th stocks in the index for that quarter fall out because they've weakened over that period. There's two companies below it, 101, 102, which then come up at the end of the quarter and replace those other two to form the new constituents of the index. And that basically means that at that point, when those two markets come in and the two weak ones fall out, the index is meant to increase based on that move. So that forms part of the positive bias where weak sections fall out of that index, creating ultimate growth for that index. However, you still need to consider that the markets overall may be still declining. So the markets move up and down, often within a certain range. This is how we can use these levels to identify where our stops and targets can go based on the likely range, ensuring our stop loss is unlikely to be hit, leaving our target in a probable position to be reached. There's increased volume and orders at the open of the market, and often that's filling a huge amount of institutional orders. This creates price spikes and surges within these estimated ranges around the open time of the market, and hence we have opportunities that we can see like this If you'd like to access these levels, please let me know in the comments because I can consider creating something to give to my subscribers so that you can use these levels and identify your own setups, particularly around the open time of the market, and make the most of index trading. If you enjoyed this video or took something positive from it, please hit the like button below. It lets me know this is helping others. To see more great content like this, please subscribe, hit the bell icon, and stay updated with the latest.